A or B?
More than half the questions were about, Mr. Buffett, what's a good way to live our lives?
Left or right?
One of the decision-making traits one has to learn in this very noisy world is to separate the signal from the noise.
Yes or no?
That's a mistake I've made before, and I think if I had listened to Mr. Buffett, I wouldn't have done that.
Welcome to The Art of Deciding with Bruce Whitfield.
Testing. 1 million, 2 million, okay. People always say, well, who should I go to work for when I get out? And I've got a very simple answer. The real thing to do is to get going in for some institution or individual that you admire.
Hello and welcome to The Art of Deciding. That is one of the world's most successful decision makers, the chairman and chief executive of the investment company Berkshire Hathaway, Warren Buffett, whose current net worth is estimated at over $165 billion. Known as the Oracle of Omaha, Buffett has become a household name. He's 95 this year, and he was fascinated with business from an early age, buying his first share at the age of 11 and filing his first tax return at 14. Over the years, Berkshire Hathaway has built an investment empire that spans industries from insurance to railways to technology, often buying stocks early in companies that become gigantic. His top 10 current shares include Coca-Cola, Apple, Kraft Heinz, Bank of America, and those have been there for decades. Buffett and his late partner Charlie Munger are two of the most famous financial decision makers in the world. Buffett is known best for his ability to simplify complex ideas and his focus on long-term value over short-term gains. His philosophy is rooted in patience, discipline, and the commitment to understanding the businesses he invests in. It's his thinking that people are desperate to know more about. And that is why, when Berkshire Hathaway holds its AGM every year in the first week of May in Buffett's hometown of Omaha, Nebraska, everyone wants to be there.
It's like going to the best wedding ever, because you've got 40,000 people who love Warren Buffett, and they love being there.
People like Hywel George. He's been a professional investor for almost 40 years, and he's a Berkshire Hathaway AGM veteran. The event is often referred to as the Woodstock for capitalists, and it's easy to see why.
It is an extraordinary experience. And we start queuing at about 6 o'clock in the morning for a 9 o'clock kickoff. So you queue for 2 hours in the cold. It's a very long queue. And you are, as you say, elbowing with 40,000 other financial people. I'll call them bankers as a catch-all. And you go from kind of a civilized walk to a little bit of a fast walk to an undignified run. And to see and be amongst 40,000 bankers all of a sudden running in mayhem to get the best seats. It was actually quite amusing. And then you get to your seat, and we were lucky we got quite good seats because I think we ran quite quickly. And you then kind of wander up to the front of the stage, or rather you can't get to the very front of the stage because I wanted to get as close as I could. But there's a barrier, probably about 20 meters from the stage, and that's the VVIP area. And so it's cordoned off, and there's probably 100 seats, and that's where Warren's family sit. That's where the board of Berkshire Hathaway sit. Tim Cook was there, and Bill Gates was there.
And then Warren Buffett appears, and people don't kind of stand up and shout and go rah rah, but you can see that they'd like to do it.
For Terence Moll, another pro-investor specialising in equities, the 2024 AGM was his first time.
And then the questions and comments begin. And what's extraordinary is that he is so clever and so funny and so insightful at the age of 93. And he does this for a total of something like 4.5 hours in these two sessions. And the questions just come and come.
As this podcast goes live, thousands of Warren Buffett fans from all over the world are travelling to Omaha, which is not easy to get to. They want to be there on the 3rd of May 2025 and elbow each other out of the way to get as close as they can to the man they think is the best decision maker in the business. I've been there myself. It was amazing. I, too, got elbowed out of the way while I was politely making conversation. You never make that mistake twice, I'll tell you. I wanted to know more from Terence and Hywel, both very successful investors in their own right. What is the secret to the Buffett magic? Starting with the fact that nothing Buffett and Munger have done is hidden. Anyone can analyse their systems and processes. So I asked Hywel first, why is there this need to be in the room?
I would compare it to a Tiger Woods in golf or a Michael Jordan in basketball. I mean, Warren has done things which, as professional investors, we are in awe of. In the same way, as a golfer, I'm in awe of Tiger Woods. I've watched hours and hours and hours of him on the television. I know exactly, I think, kind of how he does it. Doesn't mean I can do it, but it does mean I want to be close to him at some point. And it's that kind of visceral physicality almost, to be in the same room with someone who is that good.
This is all about the art of deciding. What is the biggest and most important decision to your mind of Warren Buffett's life and career?
Well, he's made a lot of them, of course. I think probably the most important one was right at the start. He actually learned from his first investing mistake. And one of his first investments was buying into Berkshire Hathaway. And he started buying into Berkshire Hathaway stock in 1962 and took full control in 1965. And he's described that as his dumbest investment ever. Because it's a textile business. It was just a terrible industry to be in. But he's smart enough to learn from that. And the way he really learned from it was by talking to Charlie Munger. And Charlie didn't join the firm formally till some years after that. But in 1965, Charlie gave him some advice, which is actually spelt out in this year's Berkshire Hathaway shareholders letter in Warren's eulogy to Charlie. So Warren says, "Nevertheless, Charlie in 1965 promptly advised me," and I quote, "Warren, forget about ever buying another company like Berkshire. But now that you control Berkshire, add to it wonderful businesses purchased at fair prices and give up buying fair businesses at wonderful prices." So an extraordinary early pivot actually away from the intelligent investor and Benjamin Graham and value investing to buying shares in Coke and holding them for 60 years. So that was his greatest decision and really made Berkshire the phenomenon it's been today. It was because of Charlie's advice. So it was Munger all along. I mean, Buffett is an extraordinarily smart man, but Munger was the visionary. And that led them the route to the investment record we now know.
Terence Moll has been working in investments for a long time, but he'd never been to the famous AGM. Does he wish he'd done it sooner?
Yes, yes, and yes. I wish so much. I really should have gone 10 or 20 years ago. But somehow, Omaha is in the middle of nowhere, and there's always something that came along, and I never did, and I really kicked myself about it.
Would it have shaped your own decision-making process and the way you thought about investments differently had you gone 20 years ago?
I suspect the answer is yes. I've always tried to be a long-term investor. We'll talk about long-term investing, but it's really difficult. I think what Warren Buffett does above all, he thinks of the long term. He thinks 5, 10 years ahead. And I think if I'd gone earlier, I would have stressed that more in my investment approach. It's something I always kind of believed in, but never put into practice enough when I think about it now.
And might that have led to better investment outcomes had you allowed yourself that immersion earlier in your career?
Quite possibly. I think what Warren Buffett has done superbly well is to buy when things are bombed out. A lot of his great buys, like when he bought Coca-Cola back in the late 80s or Apple in 2016, they were really depressed at the time. But he foresaw a future for them. And that is something that he's very good at. I think I'm reasonable at that, but I could have learned to be better.
When it comes to the decision-making process in investing, there are so many billions of variables. Take me through your own decision-making process and how you decide whether or not NVIDIA is worth buying, even though it is at stratospheric levels that make value investors quiver in their boots and lose sleep at night, or whether Apple, even at its enormous valuation, as Buffett has done, has continued to support and continues to stay investing in. That process is extraordinarily complicated. Take me through how you decide in a universe of options and opportunities how to invest.
I think my personal approach would be I'd start off with certain business fundamentals, like PE ratios, depending on the industry, or it might be price to book if you're investing in banks or whatnot, and look for firms which, in terms of the fundamentals that I look at, look reasonable, which usually means fairly valued to cheap. Then I'll study the industry and try to form a view about whether the firm's position in the industry suggests growth for the future. Sometimes you'll have a growing industry, but a firm which just can't cash in on that, which is an important one. So I kind of like growth at a reasonable price, decent valuations, and then I'll normally look at the company management, look at interviews with them, maybe listen into phone calls, look at annual reports, see how truthful, how frank they are. Mr. Buffett always talks about truthfulness. And I think truthfulness in CEOs is a very valuable and not a very common thing these days. And try to form a view, if I to give them my life savings, would I be willing to do that? Now, in the case of Warren Buffett, obviously the answer is yes. What I found is that when my answer to that was not an unequivocal yes, sometimes I've been gravely disappointed.
And it is ultimately a human judgment about other humans as to, you may have the best technology, the best business in the world performing at the best rate right now, but if the chief executive lacks integrity or the board lacks integrity or there is any question around integrity, and Buffett is very big on this, if you lose money for the firm, I will be understanding. If you lose 1 ounce of reputation for the firm, I will be ruthless. Roughly is the quote from him at a congressional hearing into the failure of a big bank. That judgment on humanity is perhaps the biggest decision-making call that any investor has to make.
I think that's right. And just 2 points about it. One is that most investors underestimate how important it is. They don't think about it enough, and they should think about it far more. And secondly, I think that is precisely what Mr. Buffett is quite exceptional at. I think he understands people very, very well, and he has quite extraordinary emotional intelligence in a way that most of us simply lack. And his investment emotional intelligence, I think, is possibly unparalleled.
Most of the entrepreneurs I've ever met, I've asked them about their most important decision. And 95% of them have said, my choice of spouse. Because without having the sort of spouse that I have and the person that I chose and who chose me, I would never have been able to create what I've created. The second most important decision is the choice of business partners and allies. And in the case of Munger and Buffett, their decision to collaborate and to do so over 60 years created a phenomenon. What was that mutual admiration, that decision point, that inflection point? Has anybody ever figured out what the Archimedes moment was between the two of them?
I'm not sure anyone has found the Archimedes moment between the two of them, in terms of that pivot we just talked about, in terms of moving into, I'll call it Coca-Cola investing. Great companies hold them forever with deep moats, franchise value, all these things we know about, and brand value. It's also interesting between the two of them because they always worked a couple of thousand miles apart. Charlie was in California and Warren was in Omaha. And maybe it's 1,500 miles, maybe it's 2,000. It's a long way. And particularly 20, 30, 40 years ago when communication wasn't as smooth as it is today. But yet they found a way to talk, I think, most days. But they didn't have the physical proximity which you'd expect of business partners. And you'd certainly expect of investment partners. And there was something in that separateness which allowed them to, I think, plow their own furrow whilst benefiting from each other's knowledge. And I think, strangely, I think that was probably very powerful and created, as you say, that 60-year track record. And again, to keep it going for 60 years. I mean, very, very rare you see in my line of work a 60-year performance track record because you've got to do it from the age of 25 to 85. I mean, who does that? While it's in my head, I mean, it's a very interesting stat in terms of the power of compounding over 60 years, which is a big part of what made it so special, both the compounding and the 60-year bit. Because the percentage of, let's call it Warren's wealth, generated over the first 30 years was just 3% of the total. 97% of his wealth was generated in the last 30 years, the second half of that performance track record. That's the power of compounding over higher and higher numbers. The other thing which is important at this point, and I'm sure Charlie was important in this decision making, was to set up a very smart structure. So they did a couple of interesting things. Number one, they invested not just in publicly quoted securities, but in private companies, famously. And the other thing they did very cleverly was the Geico purchase, the insurance purchase you just alluded to, which is what we call captive capital, which is de facto permanent capital, which are life insurance premiums which come in month over month over month, and you pay them back 50 years later when people die. And what you do with that cash in the meantime is pretty much up to you, as long as you can meet those obligations further down the line. And that Geico purchase created that what Warren called a float, and really supercharged his returns, because that's de facto free capital, which he was able to invest very cleverly.
What if the opposite is true is one of the more powerful statements that has come through in this series from a police interrogator who interrogated the killer of 77 people in Norway in 2012, Anders Breivik. And Asbjørn Raklu, the police officer who oversaw that, has fundamentally shifted the way in which interrogation techniques work in Norway and is influencing interrogation techniques around the world through the assumption of the opposite. Is that too complex in the world of investing? Because it may force you into a process of second guessing that is unproductive.
I think it should be an important part of every investor's process. Like, the one question I always ask myself about an investment is, under what circumstances could it fall in a heap and lose me a huge amount of money? And to do a kind of what they call a pre-mortem. If I was looking on this investment in 2 years' time and it was down 75%, how did it happen? Just to force myself to think more critically and to think of the assumptions which I'm making, which could be wrong. And so I agree entirely.
And also whether or not you have the good sense to cut your losses long before it's 75% down, or whether it is 75% down and you stay invested because you fundamentally believe in the business case and the work that you did previously. Where does Buffettology take us on this?
That's a very difficult one, because we all talk about believing in the business when it's down 75%, but like just over 20 years ago, Amazon lost 87% or something. And think of the number of investors who sold out at or near the bottom, who just threw in the towel, who gave up heart. And I think that kind of thing is, as usual, easier said than done. But you see, what's interesting about Warren Buffett, and people don't talk about this enough, he hasn't made any huge mistakes through his investment career. He has had no blow-ups. He scolds himself for his mistakes, but you look at the mistakes, they weren't very big. And quite how he managed to avoid those blow-ups, I do not know. I'd love to know.
Most business relationships don't last, 5 years. And yet this relationship, and it succeeded because, I guess, mutual respect, the ability to work together, probably the fact that when they did communicate, they had to be quite focused in their communications. And once they'd made a decision, it wasn't easy to send a WhatsApp to say, actually, I've changed my mind. There was time that they took. And Buffett is very big on time. He's very big on sitting, reading and learning and observing. And in a world that is increasingly short-term in its nature, where we're making split-second decisions, which we're changing a nanosecond later and altering because it's easy to do, are we at risk of making worse decisions in a hyper-connected world than perhaps Buffett and Munger had the luxury of time on their side?
Yes, and this, I'm sure, is part of the reason they've managed to make it work despite the lack of proximity, because they made very few decisions. And once they'd made them, they stuck with them for a very, very long period of time. So that was a great power in their partnership. And also they were entirely aligned in terms of their investing philosophy. If you're unaligned, misaligned, that could be a problem. And so that was very powerful. But really it was the thing behind what allowed them to hold their positions for very long periods of time. That was the decision-making genius behind it. But if you compare it to a modern fund manager, the fund manager who runs people's money, the people listening to this podcast, they will typically turn your portfolio over once a year, probably. So they're churning, what we call it. They'll churn 100% of the fund every 12 to 18 months. Buffett and Munger would hold forever, pretty much. Not exactly true, but, they hold for 10 years at a time. And the jury's out as to whether the modern fund manager really adds value in that pursuit. And if you look at the better, dare I say it, stroke the greater fund managers these days, they are ones with longer holding periods. So taking fewer decisions and holding them for longer, despite a very noisy world. And one of the decision-making traits one has to learn in this very noisy world is to separate the signal from the noise. Because the number of signals coming through is probably pretty constant over years and decades. We're just surrounded by a lot more noise. So that's a skill set one has to learn in terms of filtering the noise into the relevant signals at that point in time.
And learning the difference between what is a signal and what is just the clutter and what is overwhelming. And yet we see the emergence of many, many investing platforms. I'm going to name Robinhood simply because it is the biggest and most visible of all of them, where you almost have this Wolf of Wall Street boiler room sort of aggression to follow hype and trends. One of the biggest decisions that Munger and Buffett took together was to never follow hype cycles. And that worked for them incredibly well through the dot-com bubble and the burst. And then it worked against them for about 20 years after that, because then the world did move and did change, and they didn't ride that cycle with the emergence of the Googles and the Microsofts and the Apples and the Facebooks. They missed out on a huge opportunity, yet remain perfectly comfortable with the fact that they didn't invest. They made a decision to not do it. And that's so powerful.
Yes, and wrapped up in any kind of great stock market trend is a mixture of reality and emotion. And so I think they missed some of the reality of the tech boom, but I think they were grateful they missed out on the emotion of the hype and the mania through, call it 1998, 1999, 2000, and maybe happening today again with AI being the latest one. And it was blockchain 2 years ago, it was crypto a year before that, it was NFTs a year before that. So people jump on the bandwagon. I think it's emblematic of what you've described, which is, I'll call it the Robin Hood generation. It's a little too easy to invest right now, and I'm all for people investing. But the one thing we try very hard at as professional investors is to minimize our emotional quotient when we're thinking about what stocks and businesses to buy and hold for hopefully long periods of time, and which businesses to sell.
There is also, beneath the humility, warmth, charm, and brilliance, a ruthlessness to Buffett, isn't there?
There absolutely is. And we saw that in his purchase of, I think it was 5% of Goldman Sachs at the depths of the global financial crisis in 2008, 2009, when no one wanted to touch Goldman Sachs as a bank. All the banks were de facto bankrupt. And he stepped in, took 5% of it. He did the same with Salomon Brothers in the previous downturn. It was almost a no-lose deal because he was the guy with the capital and Goldman had to take it. So that was ruthless. I think the other piece is he's ruthless stroke disciplined in his patience quotient. It's quite extraordinary how he does this. And it was a nice quote from Charlie Munger, may he rest in peace. The first rule of compounding, never interrupted unnecessarily. And that's really hard to do when you're doing this for a living. To sit around doing nothing for months on end is really hard to do because you feel like you should be doing something.
So, back to the experience of actually being in the room at this Woodstock for capitalists, the Berkshire Hathaway AGM, the massive Super Bowl of knowledge. I wanted to know from Terence what kinds of decisions all of these fans, these acolytes, these devotees sitting eagerly in the hall want to know about.
What I found really interesting was that more than half the questions, I think, were about Mr. Buffett, what's a good way to live our lives? So this is successful, smart investors, but they're looking for advice, not in terms of making investments, but in terms of life decisions. They ask you about the kind of person that they should get married to, about the kind of businesses that they should work at, about how to deal with relationships, how to live a long life. And he had sensible answers on all of these things. I think in many ways they were looking for life advice from this extraordinary grandfather, but very, very successful figure. And I think in many cases they were intrigued by the fact that he is very successful, but as far as we know, he's kept his integrity, he values integrity. He is the polar opposite of Mr. Trump, for example. And I think people want to know, Mr. Buffett, how did you do this?
If we can make one decision using the astonishing career of Buffett and Munger, if we make one decision listening to this, what would it be?
Don't make too many of them. It's the simple answer. Patience is a virtue, and you need to think about what allows you to be patient. The thing which gives you the patience and the fortitude to ride out those ups and downs, because all share prices go up and down, the thing which gets you through those difficult stages is the work you've done and the belief set it's created in you personally, in the power of the business over long periods of time. So if Apple goes down 50%, the business model is still exactly the same. So Buffett thinks exactly the same way. And that gives him the fortitude to not care it's gone down 50%. You need to buy more.
I think it would be not to invest with companies where I'm not 99 to 100% confident in the integrity of management. That's a mistake I've made before, and I think about it now, and I think if I had listened to Mr. Buffett before, I wouldn't have done that. And I think from now on, I will be more ruthless about looking at company managements in as much detail as possible.
You have to have that true north, which is based on proper work, proper thinking, on your own, which means you create your own belief set of the value of that business in the longer term, and you can therefore ignore the share price. If you haven't done that proper work and have got your true north, you will be subject to all the emotions which get you out at the bottom and in at the top.
Hywel George and Terence Moll, thank you for helping us understand more about Warren Buffett's art of deciding. Of course, one of Buffett's most famous decisions was in 2006 when he committed to give away 99% of his wealth, mainly through the Bill and Melinda Gates Foundation. As of today, he has already donated over $50 billion, making him one of the most generous philanthropists in history. Now that is an art of deciding. Thank you for listening. You'll find us on all of the major podcast platforms, so do click follow so that you don't miss an episode. I'm Bruce Whitfield. You can find out more about me on brucewhitfield.com. Till next time, bye-bye.